Good morning and welcome to Hudson Institute. Thank you for joining us for this discussion on revitalizing U.S. investment in Latin America. This is a timely discussion. This week, Colombia signed on to China's Belt and Road Initiative. More than two-thirds of countries in the region are now participants in China's infrastructure development program. Also this week, President Lula of Brazil wrapped up a 4-day visit to Beijing, in which Chinese companies announced $4.5 billion in new Chinese investments in Brazil, ranging from auto manufacturing and infrastructure to semiconductors. Since the 2000s, U.S. investment in the region as a share of total investment flows have been on a slow decline. While U.S. companies are still leading investors in some countries and in some sectors, the U.S. private sector is ceding ground to Chinese and other investors. This retreat, if it continues, could have profound implications for the prosperity of the region and for U.S. influence in the hemisphere. In addition, this could allow for Latin America to become a home for Chinese-style state capitalism. The aim of today's panel is to examine some of the tools that could reduce barriers to investment and support greater mobilization of capital flows to the region, especially as Congress considers reauthorization of the DFC, the Development Finance Corporation. We'll also hear about how strategic economic zones could open up new opportunities for U.S. investment. We have an outstanding panel today, and I am grateful to each of our speakers for joining us. Rob Mosbacher Jr. served as 9th president and CEO of OPIC, DFC's predecessor agency, and is chairman of the Mosbacher Energy Company. Laura Burns is senior vice president of political risk for the Americas at Willis Towers Watson, one of the leading global risk brokerages. And Eric Brimman is a financier and serial entrepreneur. He is founder and CEO of Prospera Honduras. I want to start with Rob. What does Washington need to understand about the importance of investment in Latin America?
Well, Dan, thank you very much for you all hosting this, and thank you for the question. So I would start with the fact that Latin America and the Caribbean represents a market of 660 million people. And it's a market that includes people that we share values with, that we have historic ties with, and that we have cultural connections that really matter. I would venture to guess that the vast majority of business leaders in Latin America and the Caribbean went to U.S. schools or schools in Europe. And that's a bond that we share. And while in the short term, it's understandable that the focus would be on trying to reduce the flow of immigrants, illegal immigrants, and narcotics into the U.S., in the medium to long term, we have to focus on how to grow economies, how to create jobs, and how do we strengthen trade relations. But for the last 10 to 15 years, as Dan mentioned, we have neglected the area and left the field wide open to China, and China has taken great advantage. They've invested roughly $130 billion in those years, and the investments they've made have run the gamut from infrastructure, port facilities, and the like to critical minerals, wide variety. They're the largest trading partner with most of the large economies in the region, with the exception of Mexico and Colombia. They control 2/3 of the energy sector in Chile. They control virtually all the power in Peru, and it's a situation in which we're clearly playing catch-up. Probably most of you saw this week that Xi Jinping hosted a conference of the CELAC, which is a community of Latin American and Caribbean states, in Beijing, announced, as you said, more infrastructure commitments, created or talked about a $9 billion line of credit, and they had 3 heads of state. Lula from Brazil, who is always trying to navigate the way between siding with the U.S. and siding with China. So he's sort of more of a neutral player, always open for business. Boric, who from Chile is the most dependent upon the Chinese on the continent. And then Petro from Colombia, who's just a lost soul. And that's being charitable, I think. And yet, despite all the progress that China's made, and there are still plenty of opportunities out there, what it requires is that we are much more proactive, much more aggressive, much more creative, and that we take advantage of this opportunity on the reauthorization of the DFC to talk about how do we strengthen the DFC, how do we help improve the opportunity to be much more of a factor, not just in Latin America, but around the world. So I think we'll come back to the issues of how to strengthen the DFC a little later in the conversation.
Great, thanks. Laura, from your vantage point at Willis as a risk advisor and brokerage, how do you see the investment landscape in Latin America, and what are some of the risks you see on the horizon?
Yeah, thanks, and thank you, Hudson Institute, for hosting us on such an important subject. So where we're coming from as risk advisors to investors that are looking into Latin America, a couple statistics just to share. We do some research alongside our partner, Oxford Analytica, and recently we did a survey. We've been doing it for about 10 years now on perceptions of political risk. And of that survey of this year, which we just published, over 74% of investors ranked political risk or geopolitical risk as the top risk. And it was a couple of years ago following the Russia-Ukraine war where we said political risk, that was the year political risk became everybody's risk. And while natural resource organizations and others in Latin America, this political risk had obviously always been on the radar, the pink tide over the past, over decade and so forth. But really, it brought this risk issue into the boardroom, into the C-suite of all kinds of organizations, manufacturing firms, life sciences, you name it. And so in that environment now that boards are really sensitized to risk, what's happening in Latin America right now, the geopolitical alignments, the rise of populism, just the dramatic flips in policy make a long-term investment in the region really challenging. Another piece of research we did was mapping the geopolitical divides around the world and sort of this emerging almost trading block, if you will, of West and East. And of the 61 countries mostly emerging market that we focused on, concerningly, several of them, particularly in Latin America, were either becoming more neutral or actually, going sort of east, if you will, and more receptive to that. So for Western investors, this is a real issue. I mean, licenses or concessions being canceled, losing out on business. Social media has given a rise to populations where they may block an investment. So forced abandonment's a major concern, as well as political violence and currency liquidity. So those are just some of the risks that we're particularly focused on. But I would say in that environment, political risk insurance and or finance from multilateral institutions, DFC being prime, is absolutely vital to de-risking the project. Otherwise, I have several on my desk right now that one's a power project in Bolivia and they won't go but for the political risk insurance. And several others with what's in the news really do want to near shore. There was a life science company that we know of that really wanted to come from China to Honduras, but for the political environment, they weren't able, and sort of look what happened to them. So I think we, absolutely need to make sure that these investors can de-risk the project in order to facilitate that investment.
Thanks, Laura. Eric, as an entrepreneur from Venezuela who has operated businesses around the region, now based in Honduras, what is your perspective on the role and importance of U.S. investment in the region?
Yeah, thanks. Thanks for having us. A great event indeed. I couldn't agree more with what the colleagues have said. And we see this firsthand on the ground in Honduras and in other countries that we have interest in. It's a region indeed of almost 700 million people, but it's about 30 different legal jurisdictions that you have to contend with if you think of it as a region. There are countries that speak primarily English, Spanish, or Portuguese. So it's by no means a uniform region, even though it's a very significant, both market opportunity and geopolitically relevant region in the world. What we're seeing as we're promoting these special economic zones as platforms to invest in the region is that countries represent a certain degree of lack of familiarity. When you go to each of these countries, they have different legal and regulatory regimes. So a country has to, or a company has to learn from scratch how to do business in each of these places. Sometimes as a local market, they're too small to be worth the learning curve. Add to that the risk, as Laura was mentioning, some of the typical risks, but also as you have a very dynamic region, you have China now creating some lawfare backdrop, leveraging the historical ways in which business is done to their advantage at the expense of SCPA compliant companies. You have a combination of, yes, something very attractive, but a very challenging environment in which to do business. So you combine that then with the fact that you have a population which is proven to have a high degree of trapped prosperity. You have Latin Americans who is demonstrated come to the US with a rule of law environment and are able to increase their annual salaries by at least factors of 10. You have a bit of a perfect storm of what I think is very positive if certain conditions are addressed. Primarily this lack of familiarity with the legal and regulatory conditions and the perception, sometimes the very real existence of political risk. What we're seeing is that there's trapped demand. There's a lot of trapped potential, not just for geopolitical reasons, just for humanitarian, for profit-driven opportunities, U.S. enterprises that want to do business abroad, countries that want U.S. investment, but a gap in between the two to make it all work.
Thank you. Rob, you led OPIC, and you were instrumental in the BUILD Act, which led to the creation of DFC. So you understand the contours of development finance better than anyone. The anticipated reauthorization of DFC offers the opportunity to address some issues with DFC, perhaps make it stronger. What are some of the key changes that you would like to see that would really unlock DFC's potential to increase investment flows?
Yeah, so the DFC was a huge improvement over OPIC, and it brought a number of tools that the agency had never had, the most important one being the ability to invest equity in deals. That unfortunately has not been fully realized in terms of the potential because of the way the Congress, CBO, as well as OMB have decided to score equity investments. And by the way, on that specific point, many of us have argued fruitlessly for the last 5 years that equity investments should be based upon a net present value calculation, which we think makes sense. That has not been an acceptable argument to OMB or CBO. So OMB finally recommended the creation of a revolving fund, which would be capitalized with basically $3 billion and which would be used to make equity investments. And then as those investments paid returns, the returns would all go into the revolving fund and be recycled. So, that's been a disappointment, but I think at least we're going to have some type of solution. Let me give you 3 or 4 sort of big picture changes that I think would be really helpful. One, as I said before, the agency needs to be much more proactive than reactive. Historically, OPIC and then the DFC have been demand-driven. In other words, if you show up at the door and you need our help, if you're eligible, we'll try to help you. But we haven't had a proactive business development strategy to go out and actually try to build pipeline. And so we desperately need to be much more proactive than reactive. Second, we need to be much more physically present in key markets around the world. Since we're talking about Latin America, just to give you a frame of reference, IDB Invest, the private sector arm of IDB, has 300 people across Latin America and the Caribbean and going up. The DFC has 1 person working on business development. So a relationship with IDB Invest, in fact, a very strong partnership, makes all the sense in the world. I mean, not only from the standpoint of extending presence in these and showing a presence, but also sharing risk, using, for instance, their capacity for local currency that the DFC has authority on but doesn't use or can't use. So much more presence, and you can get that presence almost immediately through a partnership between an entity like IDB Invest and the DFC. Third, we need to be taking much more risk. The point of taking risk as the DFC is the more risk the DFC takes, the more private capital you'll mobilize. And part of the disappointment about the lack of private sector companies, particularly U.S. companies, throughout Latin America, while China's had a free, wide open field, is that the risk profile is just regarded as too high. And I can say that the OPIC and then the DFC since then have been dealing with a very conservative risk culture. That culture needs to change. And one way to help facilitate change is to actually compensate people for creative risk-taking in the agency. Today, they get no compensation or reward for taking risk, particularly if it goes bad. They're liable to face some consequences. So we have to change that whole paradigm. So taking more risk means you can mobilize much more private capital, which means we can bring private sector companies in a way that we haven't heretofore. On a specific question of countries in which the DFC is eligible to work, going back to the BUILD Act, the original plan was focus on low-income and lower-middle-income countries. And if they wanted to do a project in an upper-middle-income country, which, by the way, these are all World Bank classifications, but if you look at upper-middle-income countries, there are a lot of very poor countries in that where we should be doing business. But that was the setup coming out of the BUILD Act. And what it said was if you wanted to do a deal in an upper-middle-income countries, you had to get it certified by the president that it met certain criteria. That got delegated to the State Department. And then the State Department got in the middle of opining on not whether or not they should be in this country or that country or what political parties we should avoid, but rather opining on the commercial aspects of the deals, which frankly is not their strong suit. So fixing the flexibility on countries so that you can do business much more easily in upper middle income countries and even some high income countries, if you're careful and judicious about it, is another change. So last thing I'll mention, I have way too many people who tell me they'd love to do business with the DFC, but it's just so darn slow. And for all of us, and I'm a private sector business person, I've been in the energy business all my life, time is money. And if somebody says to me, it's going to take us 9 to 12 months minimum to do your deal, I'm going to say, well, that's too long. So we can speed things up. Just a couple of suggestions on that. One is, today, every project over $10 million, there has to be a congressional notification. And that entails bringing OMB into it and then a congressional notification. It goes up on the Hill. And that slows things down. And then on top of that, we have the certification process involving the State Department. So there are things we can do. Raise the threshold from 10 million to, say, 50 million. And last piece, we have a good news kind of challenge in that the agency is creeping up close to its $60 billion maximum contingent liability. That's how much in the way of outstanding deals you can have out at any given time. That needs to be raised. I would suggest it needs to be raised to at least $150 billion, and I think that would accommodate kind of the growth pattern that we're in right now. So those are some suggested changes, and I look forward to discussing those further.
It strikes me that the culture change that you're talking about with respect to approach to risk and also with becoming more proactive can't easily be legislated. Do you have thoughts about sort of deeper reforms that might get at some of the resistance to a more dynamic agency?
Yes, I mean, I think the Congress can share their view that the agency should take more risk on projects and that that will be an explicit expectation. I think, again, compensating people inside the agency is one way to show that you're serious about it and that you are genuinely hopeful that people will take advantage of that. So, yeah, those are a couple of things that we could do. You know, there are other tools, and I'm going to kind of tee up Laura on this, like political risk insurance, which can be used much more creatively and effectively on a guarantee type thing to facilitate private capital investment. That's the kind of creative risk taking that will help mobilize much more private capital.
Mm-hmm. Thank you, Rob. Yeah, so Laura, I think the role of political risk insurance is not fully appreciated. Can you talk about how political risk insurance catalyzes investments, how a lot of investments that wouldn't be viable without risk insurance are made possible through risk products?
Sure. So as I mentioned before, this is, political risk is top on the ERM risk register, and the boards and C-suites are now very sensitized to it. So now they've got to do something about it. And, prior maybe, your prospectus or your investor may say, we're going to go along for the ride. I think some of the experiences in Ukraine and some of the just unpredictability in what transpired is something that, investors have less willingness to do. So political risk insurance becomes vital to the investment, and they simply will not go without de-risking in some way. DFC is a great partner. I would love to see them emboldened to do more. And what a lot of Rob said, I would echo, just their ability to do more countries, particularly more middle and perceived to be high income countries. The time is a real factor. I mean, yes, some of these investments can take a bit to get going, but a year, sometimes we can do a bridge in the private sector market and then kind of co-insure once DFC comes along, but it's still kind of messy, and it would be great to have that be a 4-month process or 5-month process, not a year-long process. I think some of the environmental and social requirements, I mean, obviously we all know that getting a social license to operate, helps to de-risk and so forth, but they can be very onerous. And you think about sort of our competition of China, I think there's some work that we can do there. And with regard to staffing, I think, maybe building up the people that are there can help, move things along faster. So those are just some of the ways. I think in terms of using political risk insurance too, there's the traditional way where we buy, we have a policy per investor, but I think there's more strategic uses of it. So things like doing programs for a special economic zone, and then, those investors that want to come into this dome, must meet certain criteria, but assuming they can meet that criteria, let's facilitate that in order to attract the foreign direct investment. That's really vital. Or using it in capital markets transactions. If they're if making an investment grade by wrapping it with currency and convertibility or political risk insurance. So there's a lot more, even just taking the existing products that they have, but using them in more creative ways. There's a lot of opportunity there.
Thank you. Eric, strategic economic zones, clearly great potential for U.S. investors looking for an entry point into Latin America. As you mentioned, the familiarity issue is you have a very good solution for. How do you scale up strategic economic zones? How do we really drive investment through this tool?
Definitely. I mean, what you want is the best of all worlds. You want the attractive conditions that exist in Latin America for investment, whether it's the underutilized labor as well as the geographical location. But you want the rule of law conditions that you would see here in the US. So how do you get the best of both worlds? That's where special economic zones can come in. Not all special economic zones would qualify. There are over 7,000 around the world, but a subset of them, the type that have the right rule of law environment intrazone and that provide neutralization against local political risks would qualify. The way that potentially this could be scaled is if the DFC were to take as a formal policy the qualification of some of these zones as of strategic interest to the US. And so these become politically de-risked zones, by receiving an umbrella political risk insurance for the whole zone in such a way that individual projects don't have to go through the 9 to 12 month cycle with the uncertainty of whether or not they'll be covered. If it's in the zone, it's under a dome of protection. Therefore, that drastically accelerates the flow of capital and the certainty of operating within. And the second dimension would be, as Rob was saying, a lot more risk needs to be taken, but I would argue of the political type. So political risk insurance currently covers only a fraction of the value of the investment, directly aligned with how much the companies are willing to pay. But even if you're willing to pay more, sometimes the policies don't fully cover the fair market value. They'll just cover the investment put in. And nobody goes to a place hoping that maybe you get your money back. You want to get a multiple of it. So another way in which these zones can be leveraged once they are qualified as such is that the coverage is not just for the capital invested, but for the fair market value of the investment, obviously payable only if the political risk materializes, not taking market risk or operational risk. That is something that the private sector should properly take on. You can envision this policy being replicated throughout the region in countries that want U.S. investment, but cannot reform at a national level quickly enough. You know, the Washington consensus approach of hoping that a nation would reform holistically so that the whole country becomes, let's say, rule of law standardized has been very challenging. I don't think it has worked. But if they have a much lower friction pathway to creating these de-risk zones that have rule of law environment, that can have regulatory reciprocity, and on top of it, if the DFC comes on and provides an enhanced form of political risk insurance, then these will take off. There's a tremendous amount of demand in the region. There's U.S. capital that wants to flow. You just need the right operating foundation for the capital to be in sitio with rule of law and political risk protection.
So what you described sounds promising. When you talk to governments in the region, how do they respond to your proposals?
Quite favorably. If you think about what a U.S. company needs to make a multi-decade long investment in the hundreds of millions or even billions of dollars, they need stability and they need rule of law. The tools that a host nation would have to offer are very limited because national level reform is tough. Legal stability agreements as a standalone are perceived to be relatively weak over time. But if you offer a solution where instead of trying to reform the whole system, they can create these strategic economic zones, it's a much lower threshold for them to undertake. And I think it creates an opportunity also for the countries to demonstrate that they're serious. It's a stepping stone towards broader reform. It allows for almost like a testing of policy that will demonstrate themselves over time. And so there is an overall, let's say, development intention behind these as a sandbox where good policy can be tried domestically. And then, nationally you can adopt either wholesale or piece by piece the policies that work. It's sort of a lower risk, lower friction way of creating the perfect conditions in order to work with U.S. investment, which they really want. Often what we hear is, look, we would love to work with U.S. investments, but the standards are so high. Yet the Chinese don't have any of those strengths. They have other strengths, but for the politicians, those are much easier to comply with. And the reality is that in Latin America, there is a great affinity towards the U.S. still. Let's say the American brand is still strong and positive, but the standards are so darn hard to comply with at a national level. And often the local economic interest groups have a lot to do with it. So you want to try to operate in reality, not trying to overcome all those oppositions, but rather create a parallel system that delivers the goods without having to do the impossible.
Dan, it reminded me, in terms of the difference of approach that Eric was talking about. One observer said the Chinese come with their checkbooks, the Americans come with their notebooks.
Yeah, exactly.
Well, following on that, Chinese investors are known for also having greater tolerance for risk, for the uncertainty that the political uncertainty in Latin America, and also a longer time horizon. Are there ways that DFC and other policy tools could help level the playing field in terms of how American business thinks about these issues?
Well, I mean, it's hard. It's hard to apply a Chinese standard of not necessarily needing to earn a return to Americans that are clearly wanting to earn a return if they're in the private sector, or otherwise they're not going to be in business for long. But again, I think we can do much more to reduce the risk to U.S. investors as well as Western investors. I mean, I think when I talk about creatively financing deals, I'm talking about a variety of tools that include, not just concessionary capital, which, if you look at the track record of OPIC, that was almost never visible or even used. So concessionary capital, blended finance, first loss. There are a whole host of things that we have as tools that we rarely use, that we could use, that would level the playing field somewhat, meaning, if you're the investor from the private sector side, you're looking at how do I manage my risk so that I'm comfortable with the return and it's a risk, it may be a risk weighted return. So I think I think there's more that we can do, but it calls for creativity and it calls for more flexibility within the DFC on structuring deals than we've seen heretofore.
Thank you. Laura, going back to your opening remarks, it strikes me that there is room for growth for the utilization of political risk insurance. Is the reason we don't see more use of it? Is it a problem of supply, or is it a problem of price? Why don't we see more investors availing themselves of risk products?
Yeah, so I guess to build on some of what Rob and Eric had said, I think us partnering with the DFC in a proactive way and saying, okay, here are our strategic countries, here's exactly how we want to sort of plant the flag and have influence, and then kind of proactively building out who are the companies that we want to do this, and how and coming up with a pipeline to implement. I mean, to some of Rob's points, I think some of it is just awareness. I mean, it sounds silly, but I meet with companies all the time. I mean, there's been a flood of conversations over the past, month because of tariffs that don't realize that you can actually de-risk political risk. Like, a lot of the C-suites just are unaware. So I think it's, bring the sales force and partnering with firms to do that is going to be essential to the pickup. But picking up the note about the time frame, I mean, one thing that DFC does really well is offer these really long tenors of policies. So in the private political risk insurance market, typically a carrier would only want to write a program for, say, 3 years or 5 years, maybe a bit more, maybe 7 or 10. But in DFC can write 15 years, possibly 20 years, and so get in order to counter China, we need that long-term investment. Further, in terms of catalyzing confidence, the whole private market, which is extensive, it's over $3 billion of political risk insurance available to any single project. That market, the private market, is going to be much more interested in covering the risk if DFC is on the program. They offer what we think of as a halo effect. And so, in other words, if we want to get, working with an investor recently, they're looking at East Africa. The potential in this zone could be, many billions of dollars. We need more capacity. And so we need to get DFC on more programs, making them more eligible in more places, offering a bit more in terms of the compensation in order to get the private market on more, to give more capacity.
Just to help understanding that tool, so for most of the life of the agency, political risk insurance covered expropriation, currency inconvertibility, meaning you couldn't get your money out of the country, and political violence. And then if there was a claim that the agency paid on a specific transaction, then it would go after the host country government to recover the claim, the expense of the claim. And they have a very good track record, like plus 90% of recovering that. It doesn't always happen immediately, but over a period of time it happens. And so, we're still looking at extending that same general pattern, although there may be a little more risk that some of this, won't be as recoverable.
Understood.
Eric, I think there's some confusion out there about strategic economic zones because there are these charter cities out there, and some people have this characterization of strategic economic zones as a new form of a company town. How do you address those concerns, and how do strategic economic zones like Prospera really ensure better jobs, more transparency, better conditions for workers, and so on?
Sure. So it might be worthwhile defining a bit how these strategic economic zones are set up and how they're different from the traditional special economic zones. These zones are designed specifically to create the optimal conditions on the ground to attract investments and generate jobs for the local population. In order to deliver upon that, the rule of law has to be present. And in order for that to be in place, what these zones call for is essentially a public-private partnership between the host nation and a zone operator. The type of company that could be an ideal partner range the gamut. I mean, Prospera is one, but the Bechtels to Jacobs Engineering, large companies that are used to doing macro projects that can invest in infrastructure and have very good project management practices so as to operate a zone. But the key distinction beyond that is that the legal conditions within the zone are reciprocal. So a foreign company, let's say from the US or from an OECD country, can come into the zone within, in this case, Honduras or any of the countries that adopt them, and effectively operate in situ as if, from a regulatory perspective, they're complying with their home regulations in an OECD country. So the zone operator then becomes the overseer to make sure that they're complying with, indeed, the regulatory election that they make. Insurance industry plays a massive role at overseeing. Every company operating must get an insurance policy that will ensure that they're complying with the chosen regulatory framework. But now you get rid of one of the main barriers to investing abroad, which is the lack of familiarity. You can go to Honduras and operate as if you were in Germany, let's say if you're a German company and you elect German regulations, or as if you're in the US, in Texas, if you're a Texas company, for example, setting up a major energy production facility. So that's a major advantage. The fact that you have a zone operator in a public-private partnership creates a perception and a reality of a shield between the company that is a foreign enterprise, and often where 80% or so of the political risk materialize in a day-to-day basis, which is with the local bureaucracies, whether it's the municipalities or the permitting agencies, the lack of consistent timing or sometimes of standards. In this case, the zone operator is essentially empowered to handle the licensing, the permitting, and so the companies are setting up, they're dealing with an FCPA compliant US company that runs the zone, overseen by government, but not managed by the local governments. That creates a much more comfortable dynamic. The key distinction here as to why they're zoned is that they can be of various industries. They don't have to be in the traditional sense an industrial zone only, or for manufacturing or for various industries that are often picked. The magic of economic growth happens exponentially when you have no restraints on industries, because you don't really know exactly not only how a particular supply chain needs other niches to be present, or how an industry that was not necessarily viable 5 years ago now is a big thing. Rare earth minerals, for example, obviously we've known about them for a while, but now it's a huge priority. If you had created a zone that did not include that specifically, then it might not be compatible to help with that particular niche. So the concept of a public-private partnership is key for familiarity and to reduce the perception and reality of political risk. What would be missing, and I think where the DFC can play a catalyst role in a win-win scenario, is the neutralization of the political risk itself that nevertheless exists at a macro level. So sure, in a localized level, your day-to-day dealings are going to be as professional as possible because you're dealing with an FCPA compliant zone operator. But what happens at a macro level? What if the nation wants to completely change the program? And of course, we have seen this in Honduras. Fortunately, when it's all said and done, the legal provisions are very solid, so they'll withstand. But that doesn't mean that in the meantime, there's a projection of risk. The DFC providing a dome of protection through an enhanced political risk insurance policy that covers everything inside of the zone, not particularized 9 months of application on a project-by-project basis, I think puts the bow on it and creates a situation where you can drastically accelerate the flow of capital, which is the situation we're in. We have to now catch up to a Chinese counterpart that has been very successful in the region, and we have to catch up. And the last thing I'll say is this. Often it's very easy to point to, let's say, the capital that's flowing from Chinese enterprises because they have a form of concentration through state intervention. So when the Chinese invest, it feels like it's all coming from the same source. Often it is. When US companies invest, it feels very diffused because the US government is not the one actually doing the investment. So in reality, US enterprises probably invest a multiple, but it doesn't feel that way. And in the world of politics, perception can be reality. So another benefit of having these strategic economic zone is that you see in a concentrated basis the magnitude of the investment, the volume of jobs, the improvement in conditions that can be generated when you have legitimate US investment going to a region in pursuit of job creation in a win-win scenario.
Thank you. We have time for a few questions from the audience, so I'd like to open it up for questions. We have a mic in the back.
Thanks so much for the presentation. Jorge Camine. Rob, I had a question for you if you were interested in addressing it. There's a lot of discussion about priorities of where DFC should spend, and in some cases, at least, it's been suggested DFC should focus on U.S. investing. I'm just interested in your thoughts on how it should prioritize or if it should prioritize where funding goes.
Yeah, so, I mean, the DFC's expertise is international. And my view is that's where they should stay focused. However, there are ways that it can be supportive of other initiatives. For instance, there was an announcement on the creation of basically a fund or funds to support exploration, exploitation, processing of critical minerals in the United States. The Defense Department has the authority to do that and the money. So the DFC's role will be advisory and supportive. And that's, I think, a good use of the experience that we have. But I would resist diluting their focus on the international because, as I've mentioned, we are sorely tested in terms of our presence around the world. And the last thing we need to do is have to reassign more people back to work on U.S. deals. Just one other that hasn't come up, but I just want to see if I can put it to bed. There was a discussion about whether or not the DFC should be involved in a sovereign wealth fund in the U.S. So that fund is now being worked on between Treasury and Commerce, and there's an individual at Commerce who was hired specifically to do that. To my knowledge, the DFC has no role in that and will not play a role in that. So that's sort of my feeling on that. There, on the further issue of priorities, I thought what you were going to ask me was priorities of high foreign policy places versus so-called development low income. Actually, I think there's a lot more overlap between those two than people suggest. I don't think it's an either or. I think the agency consistently has said, you know, good developmental projects are great foreign policy, and good foreign policy that includes good developmental or job creation investments are good foreign policy. So, and I think the flexibility that's going to emerge in the reauthorization will allow the agency to continue to focus primarily on low income and lower middle income countries. And by continue, I mean as much as 50% to 2/3 of the deals will be in those countries. And then there'll be enough to pursue some that are more strategically focused in upper middle income or high income countries.
Thank you, Jay Kansar. My question is to Mr. Bremen. How do you mitigate, as you said rightfully, that perception can define reality or can cloud one's, reality? How do you mitigate the perception that special economic zones, such as the one you are championing, interfere or impose on the sovereignty of a sovereign nation, and also are just a new way, a neo-colonialism, so to speak?
Yeah, great question. I think the root of the question really should be whether or not there's a certain standard that is desired and necessary for legitimate U.S. companies to do business abroad. Whether it's human rights, environmental protection, or other conditions like lack of corruption and transparency. I think the answer clearly is yes, right? That we as the U.S. have a set of values and principles, and wherever U.S. capital is being invested, you want it to be in alignment with and, in fact, advancing those principles and values, not supporting the opposite. So with that establishment, the idea of certain conditions on the ground being desirable is taken care of. So then the next question is, how do you achieve those conditions on the ground? Not whether you want to have better conditions on the ground. And so you have an approach that calls for the whole country to all at once try to adopt those standards. And then you have an approach that says, hey, en route to doing that, why don't you leapfrog so you can get all the benefits of having those conditions while you're building to bring the entire country up to those standards, if that's what they want to do. So in a way, it's a less friction pathway to leapfrogging into the conditions that legitimate U.S. enterprises need to invest in an American-aligned way.
Was there a question on this side of the room or over here?
Hi, Chris Hayes, Service Academy. So on the similar kind of a point, when China brings a lot of their infrastructure projects to Africa and other places, they often import their own labor as well. In part, they have population problems and a lot of things, but also because their labor does things their way. They do things the China way. They don't have to ask a lot of questions, and they don't have to deal with whatever the local contingencies are of the local labor force. So rule of law it's a participatory thing. So it's not just the laws, but the people abiding by them and that kind of a thing. So what sorts of efforts are there to actually instill these values as values and not just as policies in the local populations?
Yeah, if you don't mind. So when the Belt and Road Strategy was launched in 2013, some of the early episodes involved not just Chinese investment, but Chinese labor and supervisors. And as you would expect, in some places that did not go over well at all. Since we're focused on Latin America in this, the idea of Chinese laborers in Latin America was almost from the start a no-go. And even China has learned a lot from successes and failures in the Belt and Road. And one of their learnings is we're better off if we low-key the Chinese labor or employment. And in Latin America, not only have they made it much more low-key, but now they're in the business, in many cases, of investing in significant numbers in existing firms. In fact, sort of investing 50 plus 1%, so they control those firms. So I think that's no longer the issue it was. I would say on the general question of and this is sort of a little bit of what Eric was saying, we're a rule of law, free market country. We ought to be preaching rule of law, free market approaches. And that's in great contrast to China. And even though they're quicker and they've got seemingly endless resources, we have a better story. And I would bet you that the vast majority of Latin American businesses would rather partner with the United States than they would with China. And part of it is because we feel better about how we conduct ourselves and the contribution we make to the country and not burdening them with debt that may be difficult to shoulder.
I would agree, and I would add to it, at least as we envision strategic economic zones and how, in fact, we have in place, 90% of the labor has to be local. That creates an incentive to train the local population. And so it goes beyond just simply building a port. You are building a capacity in the human talent locally that from a geopolitical perspective goes way beyond simply achieving a physical infrastructure. It creates a bit of friction, no doubts about it. But a lot of these projects, need thousands of workers in the beginning, not hundreds of thousands. And so there's definitely an existing, top tier of employees that might be quite technically savvy. And where there's a gap, then you invest in training institutes that they don't have to be formal universities. You just, within 6 months, you can train somebody to do basic engineering work or what have you. So it creates a very nice dynamic between making strategic investments that are for profit with a geopolitical advantage, while at the same time creating a free market approach to catalyzing development by training people up, because you have to use local labor.
Hi, good morning. Della Perez Franco from the Commercial Law Development Program at the Department of Commerce. Thank you very much for sharing your perspectives. I had a follow-up question on the strategic economic zones for you, Eric, and I was curious if you have any examples or if you have seen any sort of long-term impact of these zones really driving, the necessary commercial, legal, and regulatory reforms that sort of are the root cause, right, that are creating the barriers or disincentivizing the, investments to begin with.
Sure. Paradoxically, a lot of these models have been tried, deployed, and proven to be very effective within China. If you look at the history of how China industrialized rapidly, it was in essence by creating a network of special economic zones inside of which they had not exactly free market policies, but something increasingly closer to it. And that's what let them leapfrog. Shenzhen being the first one, and then over 70 that followed in this 14 years afterwards. So there's a proven model in how our now near adversary actually leapfrogged. But beyond that, what we're seeing in Honduras with what we're doing, it's in the early stages, but it's very powerfully showing that unlike anything else that has been tried before, is having leapfrogging effects. For example, our project alone represented well over 30% of the entire foreign direct investment in greenfield sites going into Honduras, 21 and 22, before there were some political issues. The number of jobs created in the short amount of time is unprecedented, over 3,000 direct, over 100,000 projected. The type of industries, it's not just money and jobs, but the type of industries are additive. These are not industries that were the typical low value add manufacturing. These are high value innovative sectors that are coming with a need to train locals, but also leveraging the existing conditions. And then in between those two sort of extreme examples, you do have places in the Dominican Republic and Costa Rica where they have had special economic zones that approximate closer to what we're doing when it comes to a rule of law environment, that are by now the primary sources of jobs in those areas, very compatible with U.S. investment. On the east, whether it's in the Singapore region, Hong Kong, Dubai, these are all areas that have tried significant legal and regulatory reforms at a subnational level with very significant and positive results. And Dubai is a great example where people think of it as one emirate or one city. In reality, it's a network of special economic zones, over 30 of them, that compete against each other in the provision of good governance conditions. And if you can create that same dynamic anywhere, then you have a similar outcome.
All right. I'd like to give our speakers a chance to give any final thoughts you might have, and then we'll wrap up. Eric, starting with you.
Sure. Well, I would say I couldn't be a more proud U.S. citizen by choice that comes from Latin America. And so I have perhaps a unique perspective of understanding the unimaginable, untapped potential that the region represents, sure, from a geopolitical perspective. And we're talking here with a context of a near strategic adversary essentially eating our lunch in the region. So that's definitely present in my mind, and it's sort of what creates urgency. But the root of the excitement, of the passion, the long-term vision, is that we are a hemisphere that's blessed with resources, with a population that can be relatively homogeneous. And we have neglected it. We have neglected it, sure, giving an advantage to an adversary, but also missing out a huge opportunity to both grow the U.S. economy and help lift people up that have demonstrated themselves to be aligned to American values of freedom and democracy, and have the capacity, with the right conditions, to leapfrog into their level of personal prosperity and generalized productivity. So why not take advantage of it? I think most people, when they understand the facts, definitely want to do something about it, and many have tried. And some in this panel, but just in general, Washington, D.C. is full of people that want to drive the positive outcomes. The question is, why hasn't it worked so far? And what can be done differently? And biased as I may be, because I'm seeing it that it's working on the ground, I think that a combination of enhancing these types of special economic zones to a strategic level presents a unique opportunity. And when you combine that with the DFC going through a reauthorization moment where it can and needs to up its game, activate new tools, it's a perfect combination of a need and an opportunity to address a strategic challenge, but also make sure we deal with the root causes of underdevelopment in the region. What we see here eventually landing as migratory problems can be solved at home by creating opportunity with closer ties culturally and economically if we can create the right conditions. And in respect of national sovereignty and national visions, instead of trying to impose it at a national level, you can create a tool of partnership that subnationally enables the countries to leapfrog, test, prove, and then perhaps adopt more broadly, but from the get-go create conditions for hundreds of thousands, millions of people to have a better future. So I think the conditions are given for a unique opportunity with a reformed foreign policy and development initiatives. So I couldn't be more excited to be part of this conversation more broadly, and thanks again for hosting it.
Yeah. Laura?
Sure. I guess just a takeaway that we truly are at an inflection point in the current geopolitical landscape, and it is vital that American influence prevail for the benefit of the United States and putting the U.S. first, and for the world. I'm a big private sector advocate, so I believe that it's not so much the grants and the USAID, but it's the private sector going and having and being there and having these major corporations for people to see authentically and from a real perspective, establishing a real economy, giving real jobs that's long lasting, and that's not sort of centrally planned or built, that's based on supply and demand, is truly the way to influence, to organically and authentically influence and sort of be the tide that raises all boats. Political risk insurance being vital to it, and as you were saying, this moment to affect DFC and embolden it to be able to do more in more creative ways is going to be central to making this happen.
Very well said. Thanks. Rob?
Yeah, just at the risk of sounding repetitive, I'm very optimistic about the opportunities that we have across Latin America and the Caribbean, but we have to be on the field. We have to be out there aggressively pushing, selling, pulling together contractors, whether it's the construction or whatever, so that we're making it as easy as possible for host governments to decide to do business with us. But we have to be on the field. China has prospered because they were the only game in town, and that can't continue to exist if we want to exercise the kind of influence and engagement with Latin America and the Caribbean that we expect.
Clearly a lot at stake with DFC reauthorization and with our broader approach to the region. I want to thank our speakers. I think this has been a fascinating discussion, hopefully not the last on this topic. So thank you to each of you, and thank you for our audience.
Thank you.